Warren Buffett documentary, The Most Patient Long-Term Investor. If you don't find a way to make money while you sleep, then you will have to work until you die. Warren Buffett. Who hasn't been aware of Warren Buffett? One of the world's richest individuals who routinely ranks high on Forbes' ranking of billionaires. His net worth is now ranked 9th in the world with $103.1 billion as of today. Buffett is a well-known businessman and philanthropist, but he is known primarily as one of the biggest and most successful investors. As a result, it's hardly astonishing that Warren Buffett's investment method has become legendary. Moreover, Buffett adheres to several key ideas and an investment philosophy that is widely accepted worldwide. So what are the clues to his achievement? In today's video, we're going to go over the documentary of Warren Buffett, The Most Patient Long-Term Investor. So without further ado, let's get into it. Early life and education. Warren Edwards Buffett was born in Omaha, Nebraska on August 30th, 1930. Layla and Congressman Howard Buffett's only son and second child. Warren Buffett had always been good with numbers as a child and could readily conduct complicated math sums in his head. He began reading his father's share market books at the age of 8, and by the age of 11, Warren Buffett had tagged the board of the broker house where his father used to work. His early years were filled with entrepreneurial endeavors. In one of his earliest businesses, he sold Coca-Cola, a weekly magazine, golf balls, and stamps knocking on doors. He was also employed in grandfather shops. Then, in 1944, he filed his first income tax return. As a high school student in 1945, he and a friend invested $25 on an old pinball machine, which they installed in a local barbershop. Within a few months, they had acquired several pinball machines and had them installed throughout the barbershops. He subsequently sold the company for $1,200. He was so brilliant that he told his father that he did not want to go to college and instead go straight into business. He was defeated. His education took place at Rose Hill Elementary School, followed by Alice Deal Junior High School. After graduating from high school, he attended the University of Nebraska's business school, where he read a new book on investing by a Columbia scholar named Benjamin Graham. Of course, it was The Framed and Outstanding Investor. He was so engrossed in Graham's concept, he enrolled at Columbia Business School so that he could study from Graham personally. He recalls Warren Buffett and Graham having instant brain chemistry, while the rest of the class was simply a spectator. A career in finance. Warren Buffett obtained a master's degree in economics from Columbia University. Not long after, Graham Newman invited his ex-student to join his company, the Graham Newman Corporation. Warren Buffett engaged himself in his mentor's investment strategy throughout his 2-year stay there. Graham, Warren's mentor, dissolved it in 1956. Graham eventually left the company. In contrast, Buffett moved to Omaha, their hometown. He established a limited investment partnership after gaining extensive investment experience. Eventually, his partnership grew to include 7 limited partners who contributed a total of $105,000. The limited partners received a 6% annual return on their investment and 75% of the profits beyond this standard. The remaining 25% went to Warren Buffett, who had practically free freedom to invest the partnership's capital as a general partner. As a result, his proportion increased from 25 to 29.5% over time. As Buffett's reputation rose, more people began to request that he manage their money. In 1962, Buffett started amassing stock in Berkshire Hathaway, a struggling textile manufacturer. The following year, Buffett relocated his partnership office from his house to Kiewitz Plaza, where it remains today. American Express's stock dropped from $65 to nearly $35 nearly overnight due to a scandal surrounding one of its clients. At the moment, he had learned from Graham that if the stocks of larger companies are trading for less than their calculated value, he should act smartly. So he took a risk by investing 40% of the partnership's total assets in American Express. As a result, his stock tripled in value within 2 years. They made a massive profit of $20 million. Their assets were worth $26 million by 1965. After 4 years, he explained that the market's wildly speculative desirable values were becoming increasingly scarce. Then he decided to dissolve the investment partnership. When the partnership disbanded, the investors received their proportionate equity. Some members supported Buffett, while others sought funds to handle Bill Ruan. The Sequoia Fund was created when Bill volunteered to manage their money. Others, notably Warren Buffett, put their money into Berkshire Hathaway. By the time Buffett shared, his stake in Hathaway had risen to $25 million, granting him control. In 1970, he was appointed chairman and CEO of Berkshire Hathaway Incorporated. From 1970 until the present, he has invested in many well-known and influential firms, including Apple, Coca-Cola, Amazon, and others. Buffett's philosophy. Buffett adheres to the Benjamin Graham value investing school of thought. Value investors seek stocks with unreasonably low prices relative to their intrinsic value. There is no universally acknowledged method for calculating inherent value. However, it is most commonly determined by examining its fundamentals. Thus, the value investor, like bargain hunters, seeks equities undervalued by the market or attractive stocks, but are not acknowledged by the mass of other buyers. Buffett takes the value investing strategy to a whole new level. Many value investors disagree with the efficient market hypothesis, or EMH. According to this hypothesis, stocks always move at their fair value, making it more difficult for investors to purchase undervalued equities or trade them at inflated prices. They believe that the market will soon start to reward those good stocks that were previously undervalued. On the other hand, Buffett is unconcerned with the complexities of the stock market's supply and demand. In reality, he seems uninterested in the stock market's activity at all. This is the interpretation of his famous translation of a Benjamin Graham quotation. The market is a voting mechanism in the short run, but a weighing machine in the long term. He considers each company as a whole, hence he selects stocks exclusively on their significant potential as a company. Buffett holds these shares as a long-term investment, not for monetary gain, but for ownership in high-quality companies that can generate earnings. When he invests in a company, Buffett is unconcerned about whether the market will eventually recognize its value. Instead, he is concerned about the company's ability to make money as a business. Buffett's methodology. When evaluating the relationship between a stock's standard of perfection and its price, Warren Buffett asks himself several questions. The first one, company performance. Return on equity, or ROE, is also known as stockholders' return on investment. It displays the pace at which shareholders generate revenue from their investments. Buffett always examines ROE to see if a company has consistently outperformed other companies within the same industry. The second one, company debt. Another important factor Buffett examines is the debt-to-equity ratio, or DE. Buffett prefers a limited level of debt so that profit growth is driven by shareholders' equity rather than borrowed money. This ratio depicts a proportion of debt and equity used to fund the company's assets. The greater the ratio, the more debt is used to invest in a company instead of equity. The third point, profit margins. A corporation's profitability is determined by having a high profit margin and constantly improving it. Investors should look back to at least 5 years for a decent idea of past profit margins. A high profit margin implies that the company is running its operations efficiently. The fourth point, is the company public? Buffett usually only evaluates companies that have been in business for at least 10 years. He has stated that he does not comprehend the mechanics of many of today's technological companies and will only invest in a complete understanding company. To keep in mind about public firms, the Securities and Exchange Commission, or SEC, mandates them to file financial statements regularly. These publications can assist you in analyzing crucial company data such as present and historical performance. As a result, you can make vital investment decisions. The fifth point, commodity reliance. Buffett is wary of companies whose goods are identical to those of competitors, as well as those that rely entirely on a commodity like oil and gas. Buffett finds little that distinguishes a company if it does not provide anything unique compared to another business in the same field. Buffett refers to a company's economic mode or competitive edge as any problematic feature to imitate. The sixth point: is it cheap? When Buffett calculates the inherent value, he compares it to its existing market capitalization, its current overall worth or price. Doesn't it appear to be superficial? On the other hand, Buffett's success is dependent on his unrivaled ability to determine its underlying worth precisely. Buffett's investing technique is similar to that of a bargain hunter. It represents a pragmatic, down-to-earth outlook. Philanthropic success. He is a long-term philanthropist who had given around $32.7 billion since 2006 to the Bill and Melinda Gates Foundation to be utilized for health and education reasons. Mr. Barack Obama, then President of the United States, awarded him the Presidential Medal of Freedom in 2011. Warren Buffett is still assisting and supporting his family's foundations. So there you have it. If you enjoyed today's content, make sure to like, subscribe, and click the notification bell so you don't miss any of our new videos. Until next time.